Hello guys, in this amazing lecture, Mohnish will teach us how to identify the next 100 biggest stocks. He will teach us 5 categories of 100 biggest stocks. The first category is businesses that idiots can run. The second category is great businesses with solid management. The third category is low risk, high uncertainty businesses. The fourth category is bankruptcies, reorganizations, public Lbos, and special situations. And the fifth category is upside without downside businesses.
Those are the kind of the 5 models. So we have the huge tailwinds with the idiots who can run the company and the company does well. Then the second is a huge tailwinds, but you cannot have idiots. You need smart people running it, kind of like Amazon and Geico. Then the third is markets get confused between risk and uncertainty. So we talked about IPSCO, Tesoro, Frontline, and Techcominco on that. And the final one was the grave answer, FAMZL. Bankruptcy, reorganizations, public Lbos, busted Lbos, special situations, and those can all work out quite well as well.
Don't forget to like and subscribe if you haven't done it already. Now let's jump into the first category. In this part, Mohnish will discuss 1. Seas Candies, Moody's, Coca-Cola, American Express, Visa and MasterCard business model. 2. Multi-business model and multi-fantastic moat. 3. Guy Spears mental model. 4. Guy Spears investment in crystal. 5. Why you should buy great businesses and forget about PE ratio. Enjoy this part.
So what I did is I said, okay, how do we identify these 100 baggers? And what I discovered is that if I just looked at the examples in my own portfolio and obvious examples around me, there are basically about 5 different categories that these 10 to 100 baggers fall into. Now it could be more than 5. But 5 is the one I was able to come up with before it was time for this lecture. If I come up with more, I'll update you next year. But we at least have 5 very distinct kinds of companies which should give us clues that these are businesses that we want to hold on to. So the first category of companies that has the potential for these 10 to 100 baggers is these are businesses which have huge tailwinds. Tailwinds means they just have all the factors moving in their favor. They have very deep moats. They have very long runways. They have very high return on equity. They typically don't need any debt. And the most important condition, an idiot can run these companies. So like Warren Buffett says, invest in businesses that an idiot can run, because one day an idiot will run them. So which are the companies that a complete moron, stupid idiot can run? Okay, so these are the businesses like Seas Candy, Coca-Cola, Moody's, Visa, MasterCard, American Express. These are the types of businesses which are so deep in the moats that it's, in fact, if you look at a company like Coca-Cola, they have more than 100-year history. And in the 100+ year history, for several decades, the company was poorly managed. And you have a company in China, Moutai. Maybe some of you even consume the product. With due respect, I think Moutai probably has great management, but with due respect to Moutai, an idiot can run that company. Okay, so you do not need anything between your ears. You can put me in charge of Moutai and I can run it. Even a person like me can run that company. That is an unbelievable, fantastic business. Okay, so there's a good friend of mine, you might have heard of him. His name is Guy Spear. and he lives in Zurich, and I think he's going to try to also speak to you next year. Maybe we'll both come together. We'll see if we can do back-to-back lectures. So Guy has a mental model he uses, and his mental model, which is used actually for more than 15 years, is that if he identifies a company like Moody's or S&P as a great business, or let's say if he identifies Coca-Cola as a great business, or let's say the Coca-Cola bottlers as a great business, what he does then is he looks around the world for Coca-Cola bottlers in other countries. So if he finds that being a Coca-Cola bottler is great in Tennessee in the US, then I want to find the same business in Brazil. I want to find the bottler in China. I want to find the bottler in India. And I want to go around the world looking for the Coke bottler. And I want to find which one is being undervalued. And then I want to invest in it because the economics of these Coke bottlers, no matter where in the world they are, is about the same. They all are great businesses. So one of the businesses, which is the ultimate deep moat business, is Moody's. They do the debt ratings. And even in the financial crisis, when they gave all bad and flawed and garbage debt ratings, it still did not destroy the company. This is a great business that an idiot can run. And so Moody's, Guy said to himself, what are the credit rating agencies all around the world which have the same business model like Moody's? Because Moody's is a model where they'll hire an analyst, they pay him maybe $100,000. For each analyst they pay $100,000, they're probably collecting $4 million in fees. It's just a great business. So just the economics are fantastic. So he found a company in 2001 in India, which was a very small but was a number one credit rating agency in India, exactly like Moody's was in the US. And he found that S&P 500 owned 10% of that company. So S&P had done a lot of due diligence and they bought a 10% stake in the company. That company was called CRISIL. And so Guy Spier, at that time, he was managing about $40 million. He made a small investment in CRISIL. And it went up, it doubled or tripled in 2-3 years. And then he bought a little bit more. And then another year or two later, he sold it all. He had made like 4 times his money. So sometimes I like to pour salt on the wounds of Guy Spier. Like sometimes I want to have fun with him. I spoke to him last night when I was preparing that talk. I said, hey Guy, that CRISIL position that you owned, which you sold, if you had not sold, it went up 130 times after he sold. Okay? And he's actually the kind of guy who doesn't even trade that much. He just buys and holds. So I said, hey, by the way, that CRISIL you sold back then, why did you sell it? He said, Mohnish, don't remind me. That's the dumbest thing I did. Because basically, if he had kept CRISIL, he manages 160 million. The CRISIL position would have exceeded the entire portfolio he has today. One decision. And what was so hard about that decision? Well, it wasn't hard. They were a replica of Moody's. I'd already told you an idiot can run Moody's, just like an idiot can run Coca-Cola. And idiots have run it and they've not been able to destroy these businesses. And so the first thing to do is when you run into businesses that idiots are running or can run and they still continue to be in business, buy those companies if they have these characteristics and then forget the PE ratio. Just buy and hold forever, because probably those are very, very few businesses on the planet. And I can almost bet that maybe 10 or 20 years from now, Mautai looks very different. Very different. But it's hard to tell the path it takes, but it looks like a great business. So that's the first one. The businesses that idiots can run.
The second category will include businesses like Costco, Amazon, Geico, MR Pacific, McDonald's, Domino's Pizza, and other companies. Enjoy this part.
The second is exactly like the first, except these cannot be run by idiots. So these are businesses which are exactly like the first kind, which is they have huge tailwinds, they have deep moats, They have ultra long runways. They have high ROE. They don't need any debt, but they need great management, and they do have great management. So these are businesses like Amazon, Costco, Geico, Amor Pacific, Kotak Mahindra Bank, the one I bought in India, which went up 60 times or something, Blue Dart, which is the FedEx replica I bought in India, Satyam, the IT company, then Restaurant Brands, which is the one that owns Burger King and Tim Hortons, McDonald's, Yum Brands, Domino's Pizza. These are all great businesses, but they do need solid management on top of them to make sure that they keep those franchises. But these businesses have economics that are just phenomenal, just great economics. So that's the second type of business you want to keep and look for in your portfolio. And you get these massive runs as we saw with Blue Dart and others in India. Then the third kind is the ones which have shown up the most in my portfolio. So I have never had the good fortune of having the first kind of business, which is huge tailwinds and idiots for management. I've never had that. If I ever get that in my portfolio, we're never going to sell those. We're going to keep those forever.
In this part, Mohnish will discuss the third category: low risk, high uncertainty businesses. In this part, you will learn 1. What risk and uncertainty really are. 2. What we can learn from his investment in IPSCO. 3. What we can learn from his investment in Fiat Chrysler. 4. What we can learn from his investment in Tesoro Petroleum. 5. What NIMBY is. 6. What we can learn from his investment in Frontline. And 7. What we can learn from his investment in Techcominco. Enjoy this part.
Now the third one is when the market gets confused between risk and uncertainty. And so what I want to do over here is I want to go through some examples from my own portfolio in the past. In some cases, I was able to capture the upside. In other cases, I was too stupid and I missed the upside. I made some money, but I didn't make a lot of money. So the first company I want to talk about, and sorry, these are not businesses you may have heard of, but that's the nature of this game. The ones that are going to be 100 baggers, they're not going to be the biggest names around that you've heard of. So in 2005, I invested in a steel company which was based in Canada. They were traded in the US, called IPSCO. So IPSCO made two types of steel. They made plate steel and they made tubular steels, kind of like pipelines, drilling oil wells and all that. So they made these kind of this specialized steel, which was either in pipe form or plate form. And the company had the following characteristics when I invested in it. The market cap was $2.5 billion. They had $900 million of extra cash on the balance sheet. And the company had contracts on the book because there were these pipelines that were going to buy their steel for the next couple of years. So they had a 2-year backlog where they knew that their earnings for the next 2 years were going to be $650 million each year. So you had a $2.5 billion market cap, and you had $2.2 billion between cash they already had and then cash that was coming in the next 2 years. And so you would collect about 90% of the market cap in cash in 2 years. And after 2 years, you still had all the plants and equipment and people and all the know-how. Everything was still there. But after 2 years, there was no visibility into earnings. And we know the steel business can go up and down. So the way I looked at it, I said, you know what we're going to do is I'm going to make a bet. I'm going to put 10% of my assets into this. I'm going to just sit there for 2 years. And if it doesn't work, we probably get back 90% if the company is completely gone. But I don't think it's completely gone. I think it's a real business. So what happened is a year later, they made the $650 million, and the year later they had visibility for one more year, and now they said that they would make 650 million for the third year. So now they had 3 years of 650 million, which was almost 2 billion, plus the 900 million. So now we were above my purchase price. So the stock that I bought at 45 a year later was sitting at $70. So I said, well, we are above what we paid, but we still don't know what the business does after 3 years. Why don't we just wait for another couple of years, see what happens? Okay. So in 2007, I waited one more year, and by now the stock had gone to maybe $100 or $105, and they got a buyout offer. Another company came and bought them for $160 a share. And when the deal was announced for $157 something, I sold the stock. And so we ended up with almost a 4x in about 2.5 years. Okay, and we captured the entire 4x, right? And so this was a situation where it's a highly cyclical business, and markets hate uncertainty. It's a highly uncertain business, but the risk for this business was very low. So it is what I call very low risk and very high uncertainty. So when you find a combination of low risk and high uncertainty, usually that combination is going to give you a high reward, because markets are not very good at pricing in uncertainty. They hate uncertainty, and so we get some benefit from that. And in fact, there's a business in my portfolio currently, and I don't talk much about my portfolio, but I'll just make an exception because I love you guys so much. I own a company called Fiat Chrysler, which is based in partially in Italy and partially in Detroit. And Fiat Chrysler is very similar to IPSCO. So the stock is at $6 and change. And the management of the company says that in the year 2018, their earnings are going to be around $5. And so if the management is correct about the future prospects of the business, then basically the business is being priced at 1.2 times earnings for 1 year. And so my answer to that is, okay, we'll hold the stock till 2018. If it's completely worthless as a business, I mean, they have 130 billion in sales of cars. They just started manufacturing Jeep in China. The Chinese love their Jeeps. Raise your hand if you think Chinese love Jeeps. All right, at least a few Chinese love their Jeeps. That's great. So their Jeep sales are going up like 5 times in the next 3 years in China. But anyway, so I happen to think that what they are saying makes sense. The market thinks it doesn't make sense. So no problem. Just like IPSCO, we put the stock in the portfolio and forget about it. And I'll wake up in January 2019 and see what happened. And if you invite me back in 2019, I'll tell you what happened to Fiat. And between us girls, we may end up with 5 times our money if it trades at 5 times earnings, or 7 times our money if it trades at 7 times earnings, and such. So that's IPSCO. Then there's another company, Tesoro Petroleum, and this is one which we did not capture, but we should have, but we didn't. So Tesoro, IPSCO is in the steel business. Tesoro is in the oil refining business. They have oil refineries in the United States, and in the United States, in the last 30 years, not even one new oil refinery has been built because of NIMBY. You guys know what NIMBY is? Not in my backyard. Nobody wants the oil refinery near them. So in the entire US, anyone who wants to build an oil refinery, they never get the permits. So the oil refineries that we've had for 30 years ago, are the same ones we have today. And they keep trying to tweak the oil refineries in the US to get more and more capacity, but they're not able to build new ones. And so anyway, Tesoro had a bunch. So the oil refining business in the US actually is a pretty good business. And the reason it's pretty good is because all the different states have different requirements for how the gasoline or petroleum is to be produced, and the amount of emissions and all that. So you need different refineries for different states to meet the standards, which makes it difficult for other competitors to come in. So even though oil refining may be a commodity business, it's not really a commodity business because it's got these kind of local aspects to it. So anyway, what happened with Tesoro is that there was another merger taking place with two large oil refiners, and in order to make that merger happen, they were forced to sell one of the oil refineries to make the merger happen. Tesoro bought that refinery. They leveraged their balance sheet to buy that refinery, and after they leveraged the balance sheet, the crack spread, which is the spread that refiners get to make crude oil into gasoline, the crack spread narrowed to almost nothing. So their profits went to next to nothing at the same time when they had a huge amount of debt. And so markets looked at the debt and they saw a lot of uncertainty because it is very hard to predict the crack spread. So just like the uncertainty of steel prices, the refining margins are always uncertain. And markets project present circumstances to infinity. So markets said, hey, the crack spread is small. It'll always be small. They have all this debt. They may not be able to pay the debt. What happens if they don't pay the debt? Well, what happens if they don't pay the debt is they have many refineries. They can just sell a refinery. They don't need to go bankrupt. They can just sell some assets and they can get out of the jam they're in. So I looked at the company, the balance sheet, the debt and so on, and the stock was at $7.50. It had gone down a lot. It used to be at almost $30. It had gone down to 25% of the price. So I bought 10% of assets at $7.50. 3 months after I bought the stock, it was trading at $1.33. So the 10% of assets I put in, just this alone took my portfolio down by 8%, this one position. But one of the things that always happens to me, but it only happens to me, it doesn't happen to you, is every stock I buy goes down first. And it always goes down. I don't know why it doesn't go down before I buy, but they all go down after I buy. Somehow it knows. And you know, Bruce Berkowitz is a fund manager. He calls it premature accumulation. So I always have premature accumulation. And anyway, so $7.50, we're down to $1.33. We're used to that. We're not going to sell anything. We sit there. And then a few months later, the crack spread widens and they're paying down debt and the stock's at $15. And I said, hallelujah, from $1.33 to 15, 10 times, from $7.50 to 15, double, less than 3 years, still on track for 26%. We are out of here. Or like Arnold Schwarzenegger would say, hasta la vista, baby. Sold the stock and moved on. Now, what I didn't realize is that Tesoro had a phenomenal manager, Bruce Smith, just a kick-ass manager. And he was just a master at extracting value from these refineries. He bought pipelines and refineries when the financial crisis took place. And if I had kept Tesoro from the bottom tick of $1.33, it went up 200 times till today. Okay, so from the time I bought, it went up about 40 times. So I only captured a double. Okay, but the rest of the ride I completely missed because what this guy was able to do was he was a master at buying these assets, extracting more value, getting more assets. They spun off a pipeline company. a lot of things they did. He delevered the balance sheet and all of that, and it just, even now I think it's done really well. So that was an example of a low risk, high uncertainty business where I already knew in the period I owned the stock that I was dealing with an exceptional manager, because in the conference calls I was in love with Bruce Smith. He was just a great guy. He was doing all the right things, but we missed that 40x, and there was a chance to get a 200x. And then we are going to go to another one, which is a shipping company. All these wonderful businesses, steel business, refining business, shipping. And you thought you can only make the money on Alibaba and Baidu. No, you can make the money without Alibaba and Baidu. You can make it other places. So, for example, Frontline was a shipping company, and this company basically focused on transporting crude oil. So they had something known as VLCCs, very large crude carriers that they owned. And the global fleet, at the time I invested, I haven't looked at the shipping business lately, but this was an investment I made, I think in around 2002. There were about 400 VLCCs in the world, and Frontline was the largest amongst all of them. They had about 70 of them in their fleet. 70 out of 400 were owned by Frontline. And this is the ultimate high uncertainty business. The VLCCs are chartered two different ways. Either they are time charters or they are daily charters. The entire Frontline fleet of 70 ships was on daily charters. And the daily charter rate for these ships can vary from $5,000 a day to $300,000 a day. It is a huge variance. And at that time, I don't know what the economics are now, but in 2002, once the rates went below 12 or 13,000, they were not making any money. They were losing money. And once the rates went over 30 or 40,000, they were just super normal profits, exponential profits. But the exponential profits, you didn't know what would happen the next day, because every day these prices fluctuate. But there was a particular nuance in the shipping business that I understood, and I understood this because a friend of mine in the real estate business had explained this to me. He said that, when you build these large office towers, it takes, in the US, in China it's probably much faster, but in the US it takes 3 to 5 years to get the permits and actually build these, 20, 30, 40 story buildings. And so what happens is that when office space is very tight and fully occupied, all the real estate developers rush out to build new buildings. And they all rush out to build new buildings at the same time. And the banks finance all of them at the same time because everything looks great. It's a boom business. They can see 100% occupancy. And then 5 years later, all these buildings come on the market at the same time. And what happens is the occupancy and the rents collapse at the same time. So in these kind of high-end office buildings, you have this boom and bust cycle of very high occupancy and then low occupancy, then high occupancy and low occupancy. Just keeps going back and forth because the property developers just think whatever's happening right now is the way it's going to be forever. And the people who are in the shipping business are even worse than the property developers. They believe everything that's happening right now is the way it's going to be forever. So what happens is that when these VLCCs are trading at 200,000, 250,000 a day, they all go to the Korean shipyards and place a huge number of orders for ships. Okay, and they say, build me the ships. Same like the building, it takes 3 years or 4 years or 2 years to build a ship. By the time the ships are built, all these ships get delivered at the same time, those rates collapse. And then they go scrambling again and they got a bunch of bankruptcies. So the business goes through these ups and downs. Now, one of the things that happens is that when rates go to 5,000 a day or 10,000 a day, scrapping of ships increases a lot because they're losing money. And they take the old ships and just scrap them. So they make some money. So the size of the fleet goes down at the time when the rates are low. And as the fleet size goes down, it sets up the conditions for rates to go up. And then when the capacity goes down, the rates start going up, you cannot bring in more capacity because it takes 3 years to build a ship. So the only thing that can happen is price goes exponential. So anyway, I bought Frontline at a point when these prices were at 5 or 10,000 a day, and the stock had collapsed, and it was trading at something like I think at about $6 a share. And just like with Tesoro, a few weeks after I bought it, it was trading at $4 a share. Lost 1/3. Not as bad as Tesoro, but 1/3 was gone. And then it went from $6 to $9 in a short time. I wanted to just capture that spread. It was above the liquidation value of the company. I sold the company. Anyway, because of the very high uncertainty in rates, this company, if I had held the stock throughout, even with all the recent collapse in shipping, it would have been a 40 times investment, from 4 to 160. I'm sorry, not 40. It'd be from 6 to 160, about 35 times my money. So another company which I just wanted to talk about is Tech Cominco. And this is again low risk, high uncertainty. So during the financial crisis, commodity prices collapsed in 2008. They went to nothing, right? And this company, Tech Cominco, is like the IBM of mining. They have huge reserves of metallurgical coal and huge reserves of iron ore, and you know, lots of trade with China and such. But they had done an acquisition just before the financial crisis, large acquisition. They had taken a bridge loan to close that acquisition. Then the financial crisis happened. They couldn't refinance. All the prices collapsed, and this stock went from $50 to $4. It dropped by more than 90% in 7 weeks. And when I looked at the company, it's again like the refineries. They had all these different mines and assets all over the world. Some of them were the lowest cost mines you could imagine. And the banks did not want to take over this company. The banks don't want to be in the shipping business. The banks were probably going to do what I would call extend and protect, which is they would, you know, take some fees and penalties from them, but they would extend their loans. And anyway, in fact, China came in as an investor in Tech Cominco, and in a few months, the stock was up 7 times, and I sold. So we bought at $4 or $5, we sold at $30, and then it kept going. It went to $50. So we didn't capture all of it, but we captured most of it. So anyway, that was the third criteria, which is the low risk, high uncertainty.
In this part, Mohnish will talk about the fourth category: bankruptcies, reorganizations, public Lbos, and special situations. In this category, Mohnish will discuss Samzel investment strategy and how Samzel becomes rich without paying any taxes.
Then the fourth criteria is what I call bankruptcies, reorganizations, public Lbos, special situations. So how many of you have heard of Samzel? Raise your hand if you've heard of Samzel. At least one person, the professor. Well, you know, I think you should extend an invitation. To Sam to come speak to your class. Sam is called the grave dancer. He dances on the graves of companies that are left for dead. And if you get a chance to invest with Sam, generally speaking, it's going to go really well. So Sam, you know, Warren Buffett, Samzel, and the Pritzkers, these are some of the very best people on the US tax code. They know US tax code better than anyone else, way better than Donald Trump. They really know the tax code. And I don't think Samzel has ever sent much of a tax bill to the US government, because he's just so efficient with the way he runs his tax affairs. So anyway, there was this story is a interesting story, but it goes back about 26 years. So in 1990, there was a insurer called Mission Insurance that went bankrupt. And when this insurer went bankrupt, they had 630 million in NOLs, net operating losses. So these net operating losses that the company have a lot of value if you can bring that shell company into a company that has profits, because you can shield 630 million of profits because of that loss. So Sam was able to buy that company for like 30 million, because it had nothing other than the losses, and you have to find something to. So he bought the 630 million of losses for 30 million about 7-8 years after the bankruptcy. This was in 98 or 99. And then there's another investor, Marty Whitman from Third Avenue, who also bought some of the shares in this Mission Insurance. And then they the two of them went looking for a profitable business that they could join with these operating losses, so that they would suddenly have no taxes on the business. And they found a barge shipping company on the Mississippi River, like Tom Sawyer on the Mark Twain on the Mississippi River. They found this barge company which used to send goods up and down the Mississippi, and it was profitable. So they said, okay, we'll buy the barge company, and now the barge company is not going to pay any taxes because we got these NOLs, and that's how we'll make our money. And then what happened right after they bought the barge company, the barge business went to hell. So the rates collapsed and the barge company went bankrupt. So they now had bankruptcy to the power of bankruptcy. And I don't know whether you teach them, Professor, how to calculate bankruptcy to the power of bankruptcy, but it's not good. So there are two bankruptcies now instead of one. So instead of having 630 million in NOLs, they now had 800 million in NOLs, even higher. So then they went looking for another company that they could buy, so they could take both these things and pair it together. And so they had a company called Danielson Holdings that was trading at $1 a share. And then they found a waste to energy recycler. So what this company does, it's a plant where you put garbage in on one end and you get electricity on the other end. It's a German process, and there's a bunch of these plants in the US which convert waste materials, garbage, into electricity. And the economics of this purchase was, this company had 2 billion in assets, it had 2 billion in debt, and they bought it for 30 million. Okay, and so it was very highly leveraged, but it had this kind of energy business, and they thought that they could tie it in, and so they tied it in, and then they needed some capital. So then they started to do a rights issue. That's when I found them. So the stock was at $1. By the time I was able to invest in them, it was at $9. So it had already gone up like 9 times. And then they did a rights issue. They did 2 rights issues. They bought another company. And basically in about 13 months, I had a double, and I sold. And basically, if I had kept the position, that was about a 40x from that dollar price they had, and about a 4x from where I had bought. And so as you can see, we have all these companies that are in these weird places. They're not great businesses, but they do really well.
In this final part, Mohnish will talk about the 5th category, upside without downside. He will discuss 1. The dot-com bubble. 2. His investment in Fiat Chrysler. 3. His investment in Silicon Valley Bank. 4. His strategy to play a bubble market. And 5. His 100 experience. Enjoy this last part.
And then the final one I want to talk about, which is the fifth model is upside without downside. So I also call this playing the bubble. So what happened in the in the late 90s, the dot-com boom was on in a big way, and everyone thought it's going to be transformational, it's going to change everything. So these companies like pets.com, etc., they had huge valuations. Even Amazon was a huge valuation, Yahoo, all these companies. Now, I had spent some time in technology. I knew that the internet was important, but I also could not tell which company would make it, which company would not make it. And I was definitely not interested in buying anything which was even trading at 10 times earnings. I like to buy things at 3 times earnings, or even better, like Fiat, 1 times earnings. That's even better. So I was not interested in buying these businesses. But there was a bank in Silicon Valley called Silicon Valley Bank, really good bank. And it was a normal bank, except that they had one thing. What they did was, see, in Silicon Valley, what happens is that if you are a landscaper or a gardener for Google, they'll give you stock options. If you are a chef for Google, you'll get stock options. If you are a waiter in a restaurant, they'll give you stock options. Stock options is like breathing in Silicon Valley. So this company, Silicon Valley Bank, whenever they made loans to all these .com companies, besides getting all their loan terms, they always got warrants. And the companies didn't care, they gave them warrants. So every time they would do some loan or some deal, they would get these warrants from these .coms. And they never disclosed how many warrants they had, what warrants they had, what the strike prices were. No disclosure. They only said that we just get warrants. So there was an unknown element to what these warrants were worth. But the bank itself was trading at a very low valuation, just slightly above book value, and a very well-run bank. Even now it's in existence, it has done well over the years. So I said, okay, this is the way to play the bubble, which is buy Silicon Valley Bank, and if those warrants turn out to be useless or worthless, we don't lose any money. We still have the bank. And if they turn out to be something, then we have a huge run. And basically, I think we had a 2.5. We made about 2.5 times our money in 2.5 years on the stock. And if I had held it a little bit more, another year, I would have made 5 times the money, because then they disclosed the warrants just as the 99-2000 bubble was peaking, and then they started selling those warrants. So they monetized them, which worked great. And then the other company, which was the first company in my portfolio that went up 100x, was a company called CMGI, and they were an incubator of internet businesses. And I bought them just slightly above book value, because at that time people didn't fully understand what that business was doing. So they just kept taking stakes in dozens and dozens of internet companies, and then they had a whole basket of them, and then the markets fell in love with these kinds of companies, so they took it to the stratosphere. They took it, our 100,000 became 10 million, and I sold almost nearly at the top. I think maybe 20-30% off the top I sold. And so this is kind of something that comes into play when you have bubbles. It's probably not the most elegant way to make money, but sometimes you can get these upside without downside situations when that can play out. And with that, those are the kind of the 5 models. So we have the huge tailwinds with the idiots who can run the company and the company does well. Then the second is the huge tailwinds, but you cannot have idiots. You need smart people running it, kind of like Amazon and Geico. Then the third is markets get confused between risk and uncertainty. So we talked about IPSCO, Tesoro, Frontline, and Techcominco on that. And the final one was the grave dancer, FAMZL. Bankruptcy, reorganizations, public Lbos, busted Lbos, special situations, and those can all work out quite well as well.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.